coming to our breakfast briefing. We're going to talk you through a little bit about what's been happening over the course of the last month, what we've been changing in our portfolios, a little bit about the markets, and then Max is going to spend a little bit of time talking about the cyber security thematic idea that we've been looking at in our portfolios. So without further ado, I will try to move on to the next slide. Thank you. This is a slide that's got a lot of numbers, but I wanted to take a little bit of time this month to just talk through what they mean in terms of what we're trying to do and what actually comes behind the numbers. So when we look back at September, we saw equity markets that were broadly positive, up just under 2% for the month, but a lot of the movement came in the fixed income space. So we saw quite a lot of yield movement across both dollars, euros, and the sterling curves. Geoff is going to talk a little bit about some aspects of that, but there was just a couple of points that I wanted to highlight and bring through. So the idea behind what we're doing on our models is to have this absolute return focus. This is because of our focus on the private client side. What we found slightly strange was, if you're looking from a bank's perspective, very few clients go to a bank and have this concept of what they want as a benchmark. You don't see clients turning up and wanting to have a benchmark for their money, which is 40% exposure to equities, 40% exposure to fixed income, and within fixed income, they'd like a small bit of global high yield and investment grade bonds, because a lot of clients don't have that background, don't have that knowledge. The primary focus for a lot of our clients is to preserve the wealth that they've generated and then to try and build on that, which is why when we looked at the models, our focus was CPI, maintain the wealth in real terms, and then try to build with the additional 1, 2, 3, 4, 5%, depending on whether they're in a conservative, balanced or growth model. That's why our target return numbers are slightly different for the different models, but reasonably consistent across the currencies. So if you're in a balanced model, you're kind of looking for that 30 to 35 basis points every month as a consistent return. This is different to a lot of investment managers because our focus isn't trying to match the equity upside as much as possible. Our focus is trying to deliver lower volatility, consistent returns for our clients. So when we see the markets on the equity side trading around this 2,900 level, we saw this sort of 1.9% rally in the S&P, but on the back of what? Our focus is, do we want to take equity exposure? Because if not, we won't. This is fundamentally different from the approach of a lot of other investment managers where it's, we need to have equity exposure. Our benchmark is 50% equity exposure. If we're underweight equities, we can run at 30%, maybe 40%. Our equity exposure at the moment in our models is about 4%. That's a tenth of what some other managers will be running in the same model. Now, obviously, when we have markets up 1.9%, then we, relative to other managers, have a much lower performance number for that month, but a much lower volatility. But when we saw the reversal that we saw in the first couple of days of October, that starts to justify our stance because we're looking from a risk-reward basis. We're looking to reduce volatility, not to try and chase overvalued markets higher. That's the concept behind what we're trying to do as a structure across, not just at a model level, but at an asset class level, so that we have a rigid structure that backs up what we're doing within both fixed income and equities, so that we have our rationales that we can talk through clearly and easily with you, but also in hindsight, you can go back and challenge some of the assumptions that we've made and look to see how that's filtered through into the portfolios. So that's been one of the primary focuses from us when we've been constructing the models. And now we're looking at how do we continue to develop, how do we make this process as transparent as possible, because we want the challenges, we want the interaction, we want the feedback. In the next couple of weeks, we'll be bringing out our Q3-4 quarterly. We go into a lot of detail about the structure of our models, the rationale, how we build up our exposure. And then we go into the thematic concept that we covered last month, which was water. So these are the numbers. I mean, you can see, bar the sterling, we were outperforming across the board. On a year-to-date basis, if we're looking at the dollars, our dollar conservative models up around about 11%, which is fine. We're quite happy with that. The bit that makes us different is our volatility for that is about 4.5%, nearly 5%. So our Sharpe ratio, if you're looking at it on a risk-adjusted basis, is around about 2, which is something that we're very happy with. So now I'm going to try and move on to the next slide, which is good. So I've changed the order this month because I didn't want to prattle on for too long. So I'm going to get Geoff to come up and start talking to you guys a little bit about fixed income and the credit side. Elia, can we bring the shades down, please?
Great, thanks, Simon. And for those of you who were here last month, you can see that we provide this heat map for our positionings based on sovereign and corporate bonds by geography and across the curve as well. So the major changes that we've made since last month is that we've now shifted from our short duration positioning in US Treasuries to a neutral duration. And that's based on using our MVST method, focusing on macros, valuation, sentiment, and technicals. It's been driven by the macroeconomic environment, where with the second negative print of ISM manufacturing PMI number, it came below 50 at 47 in the latest print. We've decided to move our position to neutral US government bonds. In Europe, based on valuations and the large amount of negative yielding paper that's out there, we remain underweight. In corporate bonds, we are now neutral across the shorter end of the curve for US investment grade bonds, but then overweight at the longer end. And despite the number of headlines we've seen over the past month with attacks on Saudi oil production, the possibility of Trump being impeached, we've seen the escalation of protests in Hong Kong as well. We've seen additional tariffs on Chinese goods. Despite all of that, investment grade bonds in the US have actually done pretty good. They've actually rallied. Separately, in high yield now, the spreads versus investment grade again look less attractive, so we've actually taken that off a little. And finally, with the ECB stimulus that was announced in the mid of September, we actually see a technical support for that. So we prefer European or euro-denominated investment grade to US investment grade, and I'll move on and speak about that in more detail in the latter slides. Okay, this is part of our quarterly investment piece that Simon alluded to. We speak about this in more detail, where we've actually published our reasoning and the data points that we refer to for each of these factors that we assess while forming our view on our positioning in the markets. So what's changed since last month? For those of you who were here and heard my colleague Adrian speak, we've now changed our view on the state of the economy has changed to a buy based on the manufacturing data I spoke of. Also, we're seeing, if we look at the macro point, the sub-factor global economy, we can also see that there's contagion and weakness in European markets and also in the Chinese market. So we've actually switched our scorecard on US government bonds, and we've just changed that sub-factor to a buy. Separately, with the Fed returning to continue with its asset purchase program, we've also changed the signal on the Fed balance sheet policy to a buy. And then finally, with the VIX index spiking, we're seeing a return in volatility to risk assets. We've actually changed our signal on market fear and greed to a buy. So the way this works is that with 3 additional sell indicators now compared to the previous month, you can see that our confidence factor has fallen from 40+% to 6%. So we interpret that as a neutral position, hence our neutral duration positioning in US government bonds.
if I can get my mic to work. One of the concepts that we're running is very differentiated strategies on the currency basis between the models. So Geoff has been talking about the US positioning. That's very different to our euro positioning, very different to our sterling positioning. So because we're running on a curve basis, a currency basis, how these scorecards are feeding through differs quite substantially from currency to currency. And obviously this is from the Govy perspective. So the worse the global economy looks, the more of a buy signal for treasuries. So it's kind of the inverse to what you think. Can we have our assistant to move on to the next slide?
Yeah, so to that point, there is the we've got to look at the US government scorecard from a counter-cyclical perspective. Back onto the manufacturing side of things, you can see that the latest manufacturing PMI print has been the weakest since 2009. And we expect further weakness as we approach the next several months for a number of reasons. One is that you've got the ongoing negotiations that are occurring between the Union of Auto Workers and GM. So that's been hampering production. Secondly, we've still had no regulatory resolution over the Boeing 737 MAX software. So without a fix, we could see an impact on production there. Also, with commercial vehicles, we've seen orders decline by 75% on a year-to-date basis. That's partly driven by strong year-over-year comps from 2018, but nevertheless, that's had a profound impact on orders. And separately, in the document, we found that semiconductor and retail, those two sectors, were also negatively impacted. So we could expect choppy waters ahead and another print or several more prints below 50 for manufacturing PMI. And it's not a story that's contained to the US. As you can see on this chart on the right, this is the global manufacturing index, which has pulled sharply into negative territory. So you can see that how uncertainty over trade policy is actually having a spillover effect on other developed markets. So on this point, although we see the picture worsening on a macro level, it hasn't fed into the job market yet. So unemployment numbers are still strong. It's at a cyclical high in the US. Job participation rate is also very high. And we haven't seen that have a knock-on effect on consumer sentiment either yet, which is also holding up very well. But we're keeping a close eye on that. We'll monitor that. And when we do see a shift in US consumer sentiment, as posted by the University of Michigan, we will make a change in our buy signal, and we'll keep all of our clients on top of that through our quarterly and monthly investment updates. Okay, so how does that affect our positioning? So for clients that can have the ability to take a short position, we would recommend taking a long position in T-bills, which pays roughly 1.7%, and then also holding a 30-year bond as well, and then shorting government futures in the belly of the curve, whereby you would have a duration neutral position. For clients that are long only, would recommend holding T-bills, which would in effect have the position of having a neutral duration portfolio. Okay, on to valuations then. So US now looks less attractive compared to European investment grade and high yield. And our pick last month was US investment grade, but based on valuations, we've switched over and we think USIG looks close to fair value right now. And we would make the recommendation to switch over to Euro IG. And in high yield, with the potential oil market capitulation that could affect credit pricing, and also with the US high yield index, which has a much larger concentration of energy companies, and with the recent bankruptcy filing from BG Energy, it's the Apollo packed oil and gas developer, We would prefer to be in European high yield, which also has a higher aggregate credit rating of low double B compared to mid single B for US high yield. So on that basis, on valuation and the structural difference between those two indices, we would make the recommendation to switch over from US into euro denominated instruments. And then on closer inspection of the rating buckets and also the maturities, you can see the changes on a month-over-month basis. Last month, we recommended going long between AA to BBB paper. That's at the longer end of the curve, between 10 to 15 years. And there's still value on the table, but you can see that it's trading now. Let's take, for example, AA 10 to 15, which was 2 standard deviations cheap last month. On a 90-day trading basis, it's now only 1 standard deviation cheap. So there's still value there, but with choppy waters ahead, macro tail risks on the horizon, we would prefer, as I say, to move into European denominated paper for now. But otherwise, we would say that AAA to BBB long dated paper still looks attractive. Moving on to credit. So we will publish this in tandem with our US government scorecard. This one is specific to credit. So the signals at the top for macro, it's we discuss and debate the same factors, but the signals will be different given these are risk assets. On the valuation side, we see that in terms of on the trade policy front, there are risks to revenue growth and corporate earnings, and also balance sheet strength. And we can see that growth has started to take a turn from what was high single digits and then started to pull back into the mid-single digit level. And with earnings coming up, we could see risk to that side of things. But having said that, with the stronger BBB and rated higher names, we think that, let's take an example of GE. They have so many levers that they can pull in order to retain a credit rating. For example, they've been divesting their stake in Baker Hughes. They've divested a non-core business, which is their biopharma arm, for $20 billion. At the same time, they've already cut their dividend, which is at the detriment to shareholders, but it's positive for credit investors. And yesterday, they announced that they would be halting their employee pension program in order to preserve their leverage and also their credit rating. So this is why we still have a buy rating on corporate earnings and balance sheet strength, because we think that there's still a lot of levers that these companies can deploy. And then finally, on sentiment and technicals, I don't think there's been too much of a change from last month. We saw an almost record number of investment grade issuance in September. So corporates were taking advantage of the change in rates. And also we think that's kept spreads in check, given that there was very strong demand for that new supply of paper. So overall, we have a low conviction buy in credit, but we do have our preferences for euros over US dollars at the moment. And then for our tier 1 investor visa clients, we've constructed a method in order to filter the universe of bonds into something that's far more manageable. So you can see that in a total core investable universe of 420,000 bonds, through a filtering process where we use a combination of Bloomberg tools and also our in-house bond screen tool, by filtering by, first of all, sterling denominated bonds, and then companies where their country of risk is the UK, you can see that we've taken that down to 2,000 bonds. And then given our approach and our focus on capital preservation, we only want bonds that are investment grade rated, so that cuts the number of bonds in half again. And for our clients who want capital appreciation rather than income from the coupon, we've chosen bonds that have a price of less than 103 because of the low interest rate environment that we're in. We're seeing low coupon bonds issued today, but those from several years ago still have very high coupon but very low yields. So to make the portfolio more tax efficient, we've chosen bonds with a low cash price and have capital appreciation potential. And we're kind of looking at that 2% yield area as well for our portfolio, so that they at least cover the management fees as well and have a sufficient spread over government bonds. And then that actually takes our portfolio down. So once we cap it, the maturity by 5 years, it brings our portfolio down to just 60 names, which is a far more manageable number of names where we can actually conduct fundamental analysis and actually understand each of the underlying credit profiles of the companies that we're invested in. So through this process, it's an ongoing process where we update it with new issuance coming to the market, but we expect it to be maintained in that roughly 50 to 70 number of names area, where with a team of 3 fixed income analysts, we can comfortably manage that and really understand the credits and the stories behind it. And just on to the final slide, this illustrates our portfolio of corporate sterling denominated bonds versus the UK gilt curve. So you can see that our portfolio has a superior duration adjusted return. Now we've decided to select shorter dated bonds as well, with the potential for a disorderly Brexit and the possibility that longer dated bonds become more illiquid. We've decided to choose bonds that have, or companies that have larger capital structures where we can trade in and out of the bonds, minimizing our bid-offer spread, or essentially reducing our trading costs. And we also have good diversification in the bonds that we've selected. So the sectors included are financials, utilities, consumer, energy, communications, and industrial as well. And we also, through our fundamental analysis, we're focusing on companies that have geographic revenue diversification as well. So take the London Stock Exchange as an example. Through the acquisition of Refinitiv, they've managed to diversify their revenue footprint. Also, there's Vodafone, which recently purchased the assets of Liberty's their operations in Germany and Central and Eastern Europe as well. So we're looking for companies that could potentially benefit from the move in the exchange rate on sterling as well. But no, this, in summary, shows that we are actively managing our investor visa portfolios, and we're taking the short duration approach, which actually complements and fits in with our overall view on which is through our discretionary portfolios, where we also have a short duration positioning in our sterling portfolios too.
Just before we go on to the equities, thanks, Geoff. One thing that I wanted to highlight is how the concept of portfolio management has been forced to change and adapt over the last 10 to 15 years. If you're looking from the perspective of a balanced portfolio, pre-2008, the idea of buying a 10-year government bond and getting 4 to 5% as your return, moving into credit, sort of Geoff's area of specialty, and maybe picking up an extra 100, 200, 300 basis points, and having some combination of that representing roughly 50% of your portfolio, knowing that that's going to get me 3 to 4% a year. The other 50% you can kind of use to get some global equity exposure, sit in the equity exposure, and there's your 5, 6, 7% that you're trying to target. When we come into where we are right now, we saw German yields moving higher. So what that means for Euro investors is you're not losing as much money on an annualized basis as you were at the start of the month. You're now only going to lose 45 basis points per year for the next 10 years if you buy 10-year German. If you look at the UK, we're sitting in a region of 70, but now after the recent rally in bond prices, we're down at sort of 45, 50 basis points again. So rather than starting from this perspective of 4 to 5% a year, now we're at 0.4 to 0.5% per year in the UK. For the US, we're at 1.5%. For Germany, we're at negative 0.5%. So part of that has meant that we've had to look at more investment into investment grade bonds. Then those prices push up and the spreads get tighter. Then you move into high yield, those prices push up, the spreads get tighter. And then you're left with the concept of, do I chase bonds further or do I put more money into equities? What the governments have been doing by making interest rates so low is encouraging more and more people into equities. So those of us that invested into equities in March, April of 2009 have enjoyed incredible returns over the last 10 years. Maybe not so much in Q4 2018, but nobody cares because that's all in the past. What about people who have achieved money today? What about people who have their liquidity event, people that sell their business and now think, so now I'm starting on my journey. I want my balanced portfolio. How does that look like? This is where some of the work that Geoff is focused on is having to be nimble, having to think a little bit outside the box. On the equity, the concept of buy and hold no longer exists, I don't think. When we're at the end of the economic cycle, when we've got company earnings revisions coming down, when we're looking at PMIs dropping, how can you just sit and hold equities? You kind of have this long-term transformation or transition, I should say, of power from west to east, which Trump is trying to fight as best he can. So you kind of have the standoffs and the little pieces of news that come out and cause equity markets to flutter. But we're looking from the perspective of the next 2 to 5 years. Are we going to see some sort of recession in that period? If so, how do we protect our clients' money? Is buying German government bonds when the nominal yield is negative? What about after management fees, custody fees? What about after inflation? If you add all of that in, your German 10 years yielding you negative 2.5%, if not negative 3%. How can you justify holding in a client portfolio a bond that in real terms is losing them 3% a year for the next 10 years? Or do you go into investment grade high yield? What we're doing in equities is, we jump onto the next one, trying to have this framework where we can take exposure when we want to take exposure and not when we don't. This is classic traffic light system: red bad, orange okay, green good. There's not much good. When we're looking at the overall perspective, there's no good. The best that we can get is Japan and EM, but that starts to pull in currency risk for Japan and additional volatility on the EM side. So then we're looking at, well, how do we want to take exposure? We look at fixed income from a core satellite approach, core being governments and curve positioning, satellite being on the credit side. We have the same thing for the equities, where we're looking at core as our global equity markets and the satellite as some of the thematic ideas, cybersecurity being one of them. So when we look at our core equity exposure, I mentioned earlier that our equity exposure is 3 to 4%. Our core equity exposure is 0. We, from our perspective, cannot see sufficient macroeconomic data, company valuations, investor sentiment, or technical levels to justify having exposure in our portfolios. When we take it, we'll take it quickly and we'll jump in, and not from a private bank, let's move 2 to 3% over the course of a month. We'll move 10, 15, 20% over the course of a week, maybe even more if the levels justify it. But our perspective is not, let's just sit and hold equities for the point of holding equities. Let's own equities when we want to own equities, and when we do, we'll own it in size. In May and June, when we went into the markets and came out of the markets, our growth portfolios went from 70% in equities to 0, back up to 70, back down to 0, because our focus is trying to preserve. If we don't want to own them, we're not going to own them. And that's part of the benefit of not being bound to an equity related benchmark, but being focused on trying to generate low volatility returns. So when we start looking from a valuation perspective and looking at earnings, every month we update this slide. Every month it seems to get worse. If you look at the purple line, where even whether we're looking at UK, oh, sorry, I finally got some technology to work. Next slide. I'll try not to do that again. The US, where we've seen the decline in earnings expectations, Euro stocks, which has been much more severe, but not as severe as the EM, as we can see there. But we're not looking just at 2019, given that we're in the final stretch of 2019. 2020 earnings revisions have been negative as well. When we have more and more companies coming out and negatively revising their earnings, that's not really a good time to be buying equities. At the same time as we see equity markets pushing up higher, that means valuations are getting more stretched. And that's what we're looking at in terms of negative 3.6% from earnings growth. Whenever we get earnings season, there's the two sets of numbers, the surprises and the growth. And a lot of people get caught up in the surprise. How much did every company beat their own expected earnings? And amazingly, companies manage to beat fairly frequently what they tell everyone that they're going to achieve. But what a lot of people don't focus on so much is the fact that their companies will start to guide lower. On the right-hand side, we can kind of see the negative revision on the earnings side. And some of that sector by sector is getting up to, on the IT sector, nearly 30% of companies starting to guide lower on an earnings side. And then that's kind of followed through on the sentiment, when we've seen a lot of investors looking at where are we from a macro valuation perspective. The technical levels, this kind of level of 2,900 that we've been going backwards and forwards for the last 5.5 months now. So they're starting to protect on the downside. And that's also not a good signal when we have a lot of investors trying to protect their downside. This is from the perspective of, you'll see a lot of central banks going underweight, pulling their equity exposure from 50 down to 40 because they can't go to zero. We'll sit at zero until we think that it's worth holding. So I'm going to ask Max to jump up on, I'd say, stage. Just in terms of the thematic side, for those of you that have come along before, bear with me whilst I introduce the concepts to others. Our focus here is looking at these big long-term events. We had when we were looking at performance, we looked at why do we want to own equities? And let's see if we can construct equities where we only buy what we want to buy. That's what we're able to do on the core side. And the second side is, if we want to buy thematic ideas, let's make sure that powerful, B, we have a way of analyzing, screening and constructing a portfolio, and C, let's only own those stocks. Why do we want to own other random stocks? I said in September, S&P 500 was up 2%. One of our holdings, which we took out, was Peugeot, and it was up 12%. We've got individual stocks that we like, that we want to own, but we saw that stock from a valuation perspective get far too high, so took it out. So we've got some of the thematic ideas listed on the right-hand side. I'm not going to run through them all, you'll be pleased to hear. But cybersecurity is one of the aspects that is linking so many of them together. When we're looking at increased disposable income for Asian consumers, looking at e-commerce, looking at digital life, all of those things start combining together into increased cybercrime and increased profitability of cybercrime. This isn't a how to commit cybercrime, it's a warning to companies that increasingly the cost of cybercrime for them is getting higher and higher. So one of our theses was, how can we construct at least a couple of holdings where we can kind of take almost the counter-cyclical approach and benefit from some of those companies that are helping to protect others.
Good morning, everyone. Thank you for coming. So as Simon said, cybersecurity is one of the thematic ideas that we are looking at from an investment point of view. And let me begin by saying that today information is a valuable asset, is a currency that we use every day. The amount of information is growing exponentially as well. And one of the factors that have allowed for this to happen is the technological advancement. So for example, on this slide, on the left-hand side, you can see a photograph of the first IBM disk storage unit, which was invented in 1956. It had 5 megabytes of memory and over 1 ton in weight. And today, if you compare it with the micro SD card, which weighs just half a gram and has a memory of 512 gigabytes, which is over 100,000 more. So what this allowed to happen is to grow the global internet population. So for example, on the left-hand side, there's a chart demonstrating that global internet population has almost doubled within the space of just 5 years. And in 2018, the total amount of people that had access to internet is 4.3 billion. And these people generate information. And on the right-hand side, this is just an example of how much of information is generated every minute. So for example, if you look at the first line, there's 4.4 million of gigabytes generated by Americans only, or 188 emails are sent every minute, or 4.5 million Google searches are made. Can you please move to? Yeah. So due to the growing amount of information which is valuable, this has also caused increased illegal activity to trying to get access to this information and profit from it. So on the left-hand side, there's a chart demonstrating number of breaches every year. And since it started to be registered by ITRC, the amount of breaches have just exploded. And so the peak was in 2017, and in 2018, the number went down slightly by 23%. However, if you look at the number of records exposed, this has grown by 126% to a record 46.5 million. And in terms of cumulative numbers, the total number of breaches so far is almost 11,000. And the number of records exposed is 1.6 billion. And if we look at the methods used to gain illegal access, hacking is the most popular one. And in terms of most notable hacks last year, there was a hack when hackers got access to 500 million people records within the Marriott International system. And the second one is Unity Point Health that got exposed 1.4 million of its customer records. Yeah, and this chart just demonstrates top 10 biggest hacks of the 21st century. So as I mentioned previously, Marriott with 500 million, you have eBay, Equifax, which was in 2017. But the biggest one is actually Yahoo in 2013. So 3 billion customer records were exposed. Right, and if we look at the motivation for cybercrime, this can be largely broken down into 4 categories. So money, this is the most straightforward motivation. And actually, in the recent years, this has become the most popular motivation as well. Number 2 is ideological. So this could be for any political reasons or any like strong views, religion or environmental and so on. And on this note, I can mention that in 2017, the top 3 countries where cybercrime originated from are China, US, and Russia. So China had 20% of all hacks generated, so as a source country. US had 11% and Russia 6%, but the most targeted country was US. The third one is coercion, is just when someone forces another professional who has the skills to do the cybercrime for him, for organization as well. And the last one is ego. So this is when hackers just want to be famous for what they have done. And this was the prevailing motivation in 70s and 90s, through 70s and 90s. Yeah, and so this is just an example on what I have previously mentioned about money. We don't know, we don't have information on how much the hackers got from the cybercrime for obvious reasons, but what we can look at is the bug bounty rewards by companies. So they basically hire so-called white hat hackers to test vulnerabilities in their system. And on the left-hand side, you can see that Google and Microsoft both have awarded 100,000 USD or more per found vulnerability. And if we compare these numbers with median salary of the specialists, India and Argentina are the most notable countries where the reward can be up to 16 times your salary. Yeah, on the next slide, we try to demonstrate you the average cost of cybercrime for companies. This has also almost doubled within the last 5 years, and in 2018 it costed on average 13 million US dollars for companies. And if we look at the breakdown by industry, the top 2 industries are banking and utilities. And the reasons I think are fairly straightforward. So with banking, you can extract monetary value straight away. And with utilities, this is mostly for like political reasons, when adversary country try to hack the utilities of another country. And if we look at the cost types for companies, so both internal costs and both internal and external costs have been growing. So you can see growth within the last 4 years across business disruption, information loss, revenue loss, and equipment damages. And in terms of external, investigation and recovery are the 2 categories that went down, and this is mostly due to automation and use of cloud. Right, so as the cost of cybercrime is growing every year, companies realize that they need to invest in security. And on the left-hand side, you can see a chart where it demonstrates that cybersecurity is number 2 top priority for global IT budgets. And the whole industry is expected to grow from 74 billions USD in 2016 to almost 134 billions within just 5-6 years. Yes, and if we look in terms at the breakdown of the technology savings, so this is just amount spent minus amount saved. The number 1 is security, intelligence, and threat sharing. And this is used by 67% of the companies that participated in the survey. And this generates the greatest cost savings. On average, it's 2.3 million in USD. Next one, please. Right, and also regulatory environment has been also catching up, and the most the best example here would be GDPR, which came into force on 25th of May last year, and this has significantly increased fines for non-compliance. So it can be up to 24 million USD or 4% of annual global revenue, whichever is higher. And the examples here would be Marriott International, as I mentioned previously, they face a fine of 123 million USD, and British Airways facing 230 million in USD for non-compliance. There is also a similar law in California currently being developed, but I think last time I checked, it's not came into full effect yet, but this will be something close to GDPR in Europe. And of course, investment ideas. So after we have identified opportunities within the space, we have looked at the investment universe. So we started with 3 major ETFs, which in total have 69 unique companies across all of them. We used our internally developed screening system. So we looked at company valuation, profitability, growth, liquidity, size, used our smart beta score, also fundamental research. And this is the basket of stocks that we have come up to. So there are 23 of them. And the conclusion here would be that instead of offering you just like one ETF, which might have some companies that are not very attractive, so we looked at all of those available and tried to come up with best ones that we think provide the greatest opportunity to gain exposure to the theme. Thank you.
Thanks, Max. The one thing that we've seen from our side is that the consumers, as in me and all of you guys, over the last 10 years have essentially given away a huge amount of your data for free to companies that have made billions of dollars from it. They're not naming any names: Facebook, Alphabet, Amazon to some extent. Now we're in the sort of era where consumers have woken up to that fact. And now the big question from our side is, what are we collectively going to do about it? I don't know how many investment recommendations you've seen on the back of GDPR, but now you've seen one of them. I think from our side, it's trying to look at, and the question of cybercrime, cybersecurity is reasonably new. From our side, it's also weirdly, oddly a defensive play. If you're a company and you're going into a recession, you can cut your marketing budget, you can cut your sales force, you can cut the number of internal employees. You probably don't want to cut the budget that you have to try and protect your customer data, because you don't want more fines from coming from GDPR. You don't want the embarrassment, you don't want the PR leak. So this, I think, is quite a defensive play from the macro perspective. Then the big thing from our side is trying to get companies that are at reasonable valuations. We've probably spoken definitely sufficiently to you all today. Are there any questions? That's what I like to see. Nothing from online. Perfect. In that case, thank you all very much for coming.